if you look at April overall, this has been a 3 standard deviation event. And statistically, those happen very, very infrequently. That's like a less than 1% of the time. But that type of volatility only happens in bear markets. We are in a bear market rally period. And bear market rallies are very powerful, as I just said, but they tend to be fleeting. And they tend to bring people in at an adverse time and think, the bear market's over, we're off to the races. And there's a lot of people in Wall Street either believe that or want to believe that.
The economy is now officially in negative growth territory. First quarter advanced GDP came out on Wednesday, April 30th, and real GDP declined by 0.3%. This is the first negative reading since 2022. What's next for the economy? We'll talk about this and market outlooks with our next guest, David Hay, former co-CIO of Evergreen Gavekal, and now the founder of Haymaker Publications. We'll be talking about his new venture, his new work, as well as his outlook. David, how does it feel to retire after 23 years at Evergreen Gavekal? That's a long time in the business, long time in the industry. We're happy you're still with us even after your retirement.
Well, thank you, David. Well, let me just clarify. That's actually 46 years in the financial industry, 23, the last 23 with the firm that I basically bought majority ownership of back in 2002. Mm-hmm. But it's a great privilege to be back with you. I want to congratulate you.
Thank
Your
you.
business just continues to grow exponentially. I think you're up to 200,000 subscribers/viewers, which is a great accomplishment. Is that an update number, or is it even higher than that now?
It's at 270 now. So
270.
Thank you for keeping up.
Wow.
Thank you to the viewers for tuning in and subscribing.
My God. By the time we're done today, it'll probably be 300,000.
Well, that's because you're a popular guest. You're going to have subscribers to me.
Right.
But you have an announcement.
Take any credit.
Well, no, today's about you, not about me, but thank you for the shout out. Today, you have a special announcement for our viewers, but we'll save that to the end. Let's comment on the GDP data. Let me just flip over to my screen here and take a look at this Bloomberg article so we can react together. Like I mentioned, 0.3% decline in the first quarter, well below the average growth of about 3% in the prior 2 years. The initial consensus expectation was for negative growth, but it was worse than the consensus expectation of 0.2%. And PCE was up 1.8%, and PCE price index excluding food, so core PCE up 3.5%. Your initial reaction to this data that came out today, were you surprised by negative growth?
No, not really. I mean, you could say it was a little bit worse than expected, but that's with a big, complicated economy. That's, I'd say, a rounding error, that differential. But I think what's maybe more sobering is that obviously people have been aware, business people, individuals, that the tariffs were coming. They weren't, as of the first quarter, they weren't aware because so-called Liberation Day, which I call Obliteration Day, happened in early April. So that really didn't impact those Q1 numbers, but people were trying to get ahead of the tariffs. So it created this surge of buying. We've got a visual coming up here in a bit that'll look at basically new orders versus inventory. So a lot of the spending has been basically pulled forward, and a lot of inventories are building because of this. So I think that it's not great to have that first quarter negative because of almost the artificial lift you got from trying to beat the tariffs. So that, to me, would be the biggest negative of Q1.
A lot of this was just import data coming in stronger. Do you think that this is maybe just like a one-time, one-quarter glitch because of what you just said, or is this the beginning of a longer structural decline in economic growth?
I'd say yes and yes. I mean, again, I think the first quarter was flattered, and the fact that it was import surging. I mean, we're hearing these stats, I'm sure you are too, of ships that are, leaving China 50, 60% empty, and that there's a very real possibility of almost COVID-like supply chain glitches and dislocations coming up. So you've had this, enormous front loading that's gone on. So it's created this, kind of a little bit of a sugar, more than a little bit, I'd say a lot of a sugar high for the economy. And that's why I think the fact that it was a negative number, despite that, isn't great.
I think this is what you're referring to here, by the way. I was just looking at this chart yesterday. Container bookings from China to the U.S. falling sharply. Look at this.
Yeah, I mean, there you have it. It's
45% year to date, year on year, rather.
Yeah, and I think that's going to be really disturbing to Americans if we're let's say during the summer, we're looking at almost a COVID situation where people start worrying about, well, can I get toilet paper again? That's hopefully that's not going to happen. But and we have built up inventories, but those inventories will draw down relatively quickly with those kinds of exports from China collapsing. And of
So
course, China produces more manufactured goods than all the major economies put together.
you're,
So China is obviously hugely important.
what you just mentioned is not unique in terms of what you just said because other people are sharing your view. David, this is from CNBC quoting economist from Apollo. The consequence will be empty shelves in the U.S. stores in a few weeks and COVID-like shortages for consumers and for firms using Chinese products as intermediate goods. They're not even saying later on in the year, they're saying in a few weeks. Now, the COVID-like shortage brought about super high inflation. So first of all, can you just evaluate this statement? Is this a little bit too alarmist or is this realistic? And second, if it happens, what happens to inflation?
I don't think it's alarmist. I think it's realistic. I mean, these are shocking plunges in exports from China, which is critical to the world supply chain. And I think the problem is even if Trump and Xi smoke the peace pipe tomorrow, some of these it's going to take a while to refill the pipeline, if you will. So yes, I think there's going to be lingering problems, but I also think that it's more than just the tariff tantrum. I think there's a fundamental weakness that's been emerging in the economy even before the tariffs kicked in. And I actually think the Q1 number that you've been talking about is proof of that. But we've got some other things there that we could look at under the economic category that are indicative that this is a trend that's been underway for a while. If we wanted to look, if it's okay with you to look at the credit card, what's going on with credit card delinquencies,
Yeah, let's take
consumer
a look.
loans overall, they're obviously surging. And as I think David, we pay a lot of attention to multi-year ranges. So if we look at slide 4 there,
Hmm.
so there you are, credit card delinquencies. So this is the point I was just going to make. So this is going back to 2013. So this is basically a 12-year range. And if it was a stock, based on our theory, which is when they break out of these long trading ranges, they're great buys, you would say this is a buy as a stock. But in this case, it's a negative because it's showing delinquencies. But my point is, and this is something I found repeatedly with macroeconomic data, is it follows the same kind of pattern that stocks do, that these breakouts to multi-year highs, and the longer the range has been in place, the more meaningful the breakout. So I think this is concerning. And then we can see the next thing. Next one is consumer loans overall, charge-offs, also a major breakout. And by the way, David, if we went back to 2021, when the world was pretty much convinced inflation was transitory, it was showing a massive breakout at that point. You could do the same thing with Japanese interest rates. So this is a pattern that just keeps repeating. These breakouts that then keep running, and how far it's going to run, I don't know. But I would say that this is going to get a lot uglier given the economic trends that we're dealing with. But it kind of illustrates my point that even before the tariff tantrums, things were not looking great for the consumer. And I think there's many other. We'll look at some other things that are indicative of kind of this inherent weakness. I think our next one, if we go to the yeah, this is exactly what I was talking about a moment ago.
Mm.
So this is looking at manufacturing new orders versus inventories. So inventories are up at a very high level relative to new orders. So not a good sign, right? And then it compares it to the S&P, and what you can see is that typically when this indicator crashes, which it has, then the S&P follows, which it has started to do. But as we know that with this rally that's happened recently, the S&P is nowhere close to factoring in or pricing in a recession. It's really kind of pricing in just a kind of a growth pause. But some of these things that we're going to look at would indicate that this is much more severe than just a growth pause or a quasi soft landing.
That's interesting. Just
So
on
I
that
think
note, I think it was Goldman Sachs updated their recession forecast to 45%. It was higher than before, and I wonder which side of this fence are you on? Are you on the fence of slower growth but still positive growth, or just outright recession, which is the 50% that Goldman's projecting?
at this point it favors a recession. Now things are obviously very fluid, and we've got a president who's extremely mercurial, and who knows what he's going to say tomorrow. But I think the problem that he's got is he's created tremendous uncertainty. And when businesses and individuals are uncertain about the future, when they're confused, what do they tend to do? They tend to sit on their hands. They don't spend as much. And certainly, if you're a business and you're thinking about hiring a bunch of people or making a big expansion or an investment in a plant, you're reluctant to do that given how uncertain the backdrop is right now. So I don't think this is going to go away right away. So yes, I would say the odds at this point favor recession. Before the tariff, the pivot that he did back whenever it was April 9th or April 10th, I thought the odds were as high as 80%, 80, 90%, but then they kind of went down because of his change in it. But you just can't keep flip-flopping like this and expect people not to react and to have a loss of confidence and a loss of visibility.
Can we take a
So if we go ahead, you tell me.
Oh, I'm sorry. I was going to say, can we take a look at slide 7, which is the ratio of leading to coincident indicator? And
Perfect. That's just what I was going to talk about.
your great minds think alike.
You have ESP. Yeah, great minds. It's like the David Vulcan mind meld again.
Yeah, the David square show. What does that blue line, horizontal line on the x-axis indicate?
So that is, I'm not sure what that is.
Okay.
Frankly.
It's touching some maybe it's a historic average low or something. But anyway, what is the relevance?
Point is that it's
Yeah.
well, the point is if you look at this line, so this is because leading indicators have been down for like 36 of the last 39 months. It's been a tremendous decline in the leading indicators. The coincident indicators were holding up better. So they are basically measuring current activity. So now they have come down. So this ratio has come down to a level. So again, this is the leading to the coincident that has only been touched during recessions. And actually, you can see the recession of 1990, the recession of 2000, which coincided with about a 50% market decline. That's when the NASDAQ went down almost 80%. We're below both of those times. So we're basically not too far above the Great Recession. We're not too far above the horrible recession that happened in the early 1980s when Paul Volcker took short-term interest rates over 20%. So this isn't, certainly, again, I don't know that blue line. I didn't create this chart, but it's a level that is rarely touched. And I think that, we're going back 50 years on this chart. So it should be an eye-opener. And I think the problem is, David, that so many of these things this one didn't look as bad back in 22, because you mentioned in 2022, there was a negative quarter. There actually two negative quarters. I think one got revised to kind of break even back in the first half of 2022. But at that time, that's when I think Goldman had over a 90% recession probability, and the whole street was convinced. And it looked for a while like we actually did have a recession in 2022. And then things came roaring back. And a big factor, as we've talked about before, was we had the enormous deficits, which were tremendous stimulants to the economy and offset the Fed easing. And then the Fed kind of was doing stealth QE. And so there was a tremendous amount of liquidity that got injected toward the end of 2022 and into 23 that led to a recession avoidance and, of course, the bull market that was so strong in 23 and 24. But frankly, those liquidity spigots are getting turned off. So I think that we have to, and I think that's the thing, is that there were so many kind of false alarms back a couple of years ago that there's kind of a tendency to dismiss these things as, well, they were wrong before, they're going to be wrong again. But I think that's a dangerous mindset given how powerful the headwinds are right now.
All right. Can we just one more slide before we move on to the stock market? Slide 8 is an interesting chart. You've got here divergence of deficits versus corporate free cash flow. First of all, it looks like corporate free cash flow, the blue line, is looking pretty strong. It's been trending up structurally ever since the beginning of the 2000s. And it doesn't look like deficits widening have been hurting corporate profits. So can we just explain this chart?
Well, what I was alluding to, this is one reason why the stock market was so bubbly in 23 and 24, is because you had these huge government deficits. The deficit went from $1 trillion to $2 trillion almost overnight. It's still running north of $2 trillion, by the way.
Yes.
So what happens is when the government's running large deficits, that's very beneficial to corporate profits and free cash flow. It's not sustainable. It's not healthy, but it does create this kind of pseudo prosperity that I've often talked about and written about. So this has been part of the illusion that we've had this tremendously strong economy. A lot of people talked about American exceptionalism. What's driving this American exceptionalism? Well, so much of it has been because we were exceptional in our deficit spending. Our deficits were far, far above any other developed country. So no wonder corporate profits were strong. No wonder the stock market was strong. but it's kind of like crystal meth. You can use it for a while and you get this tremendous surge of energy, but at some point, you get the payback, and the payback is brutal.
Great. Can we move on to some slides on the stock market now, David? I want to get your outlook for the markets, given this economic outlook that we were just talking about here.
Well, first of all, I'm suspicious that this rally is going to continue, but I want to give the bull case a shout out right here at the beginning. Mm-hmm. So this got quite a bit of press last week. So I think you might remember Marty Zweig. He is more my age. Unfortunately, he passed away a little over 10 years ago. But he was like the David Lynn of the 70s and 80s. He was a constant regular on Wall Street Week. He's the one that famously anticipated the crash of '87, October of '87, and was a great guy, very, very successful technician. That's what he specialized in, more was technical analysis. And he created the Zweig breadth thrust indicator. And then there's the super Zweig breadth thrust indicator that was just triggered last week. And that's really what this is showing. There's only been, I think this is the seventh one since 1963. And I think we can go to the next to see the table below that. That's what the green dots are showing on the scattergram down below. But what you look at, you see is there hasn't been a whiff. Every single one of these, and it actually goes back to 1962, has led to 20% plus returns a year out. So you got to chalk that one up and say that's very encouraging. And some of those returns have been huge. Now, it's fair to say that some of them did happen within bear markets that were not fully complete. So in other words, some of those bear markets got worse before they had the big rebound. And I think that's maybe something we should be cognizant of in this case. Plus the fact that almost all of those market environments were when the market got quite cheap. Maybe 2023 was a bit of an exception, but certainly a lot cheaper than it is now. I mean, we're dealing with a market that's trading for 20 times forward earnings estimates, and those earnings estimates look optimistic. I mean, the revisions are coming down rapidly, but they're still showing something like 7.5% earnings growth for the S&P for this year. I think it'll be doing good to break even. So the PE, what I'm arguing is the PE is actually higher, but nonetheless, this is a very positive factor to consider. And I guess I would just say that it could be right, but it could be right later with after another 10, 15% decline, which would be my suspicion is what we're looking at.
Do you think then that the S&P 500 has more downside risk at this point? In other words, are risks
yes.
the upside or downside more?
I think right now they're the downside. And we wrote a few weeks ago that we thought the market was going to rally. In fact, one of the visuals we have, and one of the reasons we thought it would, was the fear and greed index got to extreme fear. And we also had the VIX up at a level where there's almost always a rally. So it seemed to us a perfect setup for a market rally. And yet what we have to remember, there you go, there's fearful people. This is from like 3 weeks ago. Mm-hmm. I think it was as of April 4th. So at the beginning of April, and probably that arrow got even further to the left there at one point. But one of the classic signatures of a bear market is you get very powerful rallies. So if you went back to the 2000, 2001 bust that I talked about earlier, when the S&P went down roughly 50%, the NASDAQ, believe it or not, was down 78%. There were a dozen days when the market rose 7% or more. So 7% one-day moves happened a dozen times in 2000, 2001 on the way to basically a valuation, like a stock split, 2-for-1 stock split where you didn't get the additional shares. I mean, when it got cut in half, it was a disaster. Unfortunately, most people were overweight tech back then, just like they are now. So if you look at April overall, this has been a 3 standard deviation event. And statistically, those happen very, very infrequently. That's like a less than 1% of the time. But that type of volatility only happens in bear markets. So I think when you put all these pieces together, what it tells you is we are in a bear market rally period. And bear market rallies are very powerful, as I just said, but they tend to be fleeting. And they tend to bring people in at an adverse time and think, the bear market's over, we're off to the races. And there's a lot of people on Wall Street either believe that or want to believe that. I don't. Okay. But again, I've only been doing this 46 years.
Are you ready to meet the biggest minds in Bitcoin face to face? Well, this summer, the crypto capital of the world isn't Silicon Valley or New York or even Miami. It's Las Vegas, introducing Bitcoin Vegas, the ultimate Bitcoin event of 2025. And this is not your average conference. Join real conversations with people shaping the future of money thought leaders like Michael Saylor, Lynn Alden, Ross Ulbricht, Winklevoss twins, David Sachs, and many, many more. Whether you're a hodler, builder, or just Bitcoin curious, BTC Vegas is where ideas ignite, partnerships form, and conviction grows in the space. Tickets are going fast, so lock in your spot today using my link down below or scan the QR code here. You'll get a 10% discount. Get it before tickets are sold out completely. We'll see you in Vegas. Well, yeah, I mean, it's not long enough. Make it 47 and we'll make it 47 and we'll trust you, David. Okay, so any particular safe haven assets that you would be looking at right now? It's interesting because treasuries disappointed a lot of investors in early April. As you know, yields went up alongside a dollar falling, which is a topic on its own, which we can revisit in just a bit. But do you think treasuries then are still the place to go? Do you still trust treasuries when stocks fall again is basically my question.
Not really. I think short treasuries, the belly of the curve, kind of that 3, 5, maybe 7-year maturity, those are fine. I think shorter is better than longer because I think what you touched on is a very important point. And something I think we talked about even before was that we thought that in a recession, interest rates could actually rise, long-term rates could actually rise in the US. And a lot of people kind of laughed at that and said that's impossible. But we saw that, at least with rising recession fears earlier this month and a falling stock market, the treasury market fell out of bed, as did the dollar. And as you alluded to, that's not normal. They're usually considered to be anti-fragile assets, safe havens during times of turmoil. So I think that's a big heads up that it's different this time, which is what we've been saying and writing for a while, and other people like Jeff Gundlach. And it actually, I want to also give you kudos because you just had Neil Howe on, who's one of my absolute heroes. And so I'm honored to be coming on just a few shows after Neil. And I did listen to it. And of course, he's adamant that we're late in the fourth turning. And it's the late in the fourth turning when a lot of bad stuff can happen in a relatively compressed time period. And I think that's what we're seeing too. And I know he believes there's going to be quite a bit of inflation in this kind of final act of the fourth turning. And I agree with that. And I think the way gold has been behaving is quite interesting because that has been our favorite anti-fragile assets, something that would do well in tough times, which it certainly has. I know it's corrected a little bit lately, got way overbought.
Well, let's flip over to a chart of gold while we're talking about this, because sure. I think chart 19, you highlighted this. Let's talk about gold and gold miners, David.
Yeah, so quite a difference between gold and gold miners. Miners have been lagging severely, the price of gold, but here's gold adjusted for inflation, which, that's kind of the classic breakout that I was talking about earlier, which happened, the big breakout happened in 2024, and then it just kept on going, but it looks awfully extended right now. The miners are in a different situation. They lagged tremendously until recently. They have been performing much better. They're up nicely this year versus the S&P being down. So they are starting to come to life, but still they've been dogs for so long. They have a lot of catching up to do, and they too have had impressive breakouts. They've broken out of a 12-year trading range recently. So I think, they are likely to correct. In fact, they have corrected, which is something that we wrote about here a few weeks ago. But I think it's going to be a relatively shallow and contained correction for the gold miners, and then they'll be up again. So it's an area where, for example, outflows from the main gold ETFs just continue unabated. So there's absolutely no investor enthusiasm for the gold mining ETFs like GDX and GDXJ. At this point, GDXJ may be the better play, but I just think in general, if you're bullish gold, you're better off at least taking some of your gold, especially since it's up so much, and redeploying it into the miners.
The next slide is about gold miners and, SLV short interest is silver. So gold miners trading at the cheapest levels relative to gold prices. Value trap or opportunity? What does that look like to you?
Well, again, I think there's a correction underway in the gold miners right now. They had a heck of a run. So, but I would say, you look at this chart, it makes my point. This is clearly a basing pattern that's in place. There's been a tremendous lag, and I think there's a lot of catching up to do. And I think what's going to drive them is I think Q1 earnings for the gold miners are going to be just boffo, blow your socks off, blow your hair back. At these prices, even companies like Newmont are going to be incredibly profitable. And then you got the really fine ones like Agnico Eagle that have been flourishing even before gold went over 3,000, and Alamos AGI, those have been the stars, a few others. But even the big boys like Barrick and Newmont are going to make really good money in this environment.
Yeah.
And I've got SLB up here because you've had some people on. I think you had, was it Mr. Kunkun from Dolly Varden,
Yeah.
who's a very articulate champion of silver. And when I look at this silver short interest being as high, so this is the SLB ETF. So obviously tremendous bearishness, or at least apathy, but this would look like outright bearishness. Then if we look at the chart of silver coming up, it had an impressive breakout here recently last year. It has run up, so that's what that horizontal line. This one I do know that was the resistance point that it broke through, and it has had a nice run. It's kind of consolidating after breaking out, which is not a bad time to accumulate. So I think silver has a lot further to go in this bull market for precious metals. I think platinum is another one. I mean, remember, even you, David, at your young age, can remember when platinum used to trade at a premium to gold. And that's why American Express would say, well, we have the platinum card up here and then the gold card down here. Well, platinum is like a third, less than a third the price of gold right now. It's amazing.
Yeah. Uh, Silver's been underperforming gold though in the better half of the last year. Again, this is a little bit bizarre given that silver had in the past outperformed gold during bull runs. What's your reaction to the gold silver ratio reaching over 100?
Yeah, it's over 100. That's why I'd say it's a really good buy. But there is a method to the madness or the distortion, which is that silver has kind of a binary aspect to it. It's both a store of value precious metal, a less precious metal than either platinum or gold, but it's also an industrial metal. And so it's the fears of a recession which are hurting the perception of demand for silver, which could be mistaken. And one of the reasons I say could be mistaken is that a lot of the demand drivers from silver are pretty non-sensitive to the economy. And by that, I mean military. The military applications for silver are immense. It's I forget how many ounces go onto each warhead, each one of these missiles that they shoot. But there's a lot of need for silver in military applications. There's a lot of need for silver in solar panels. And solar, even though it's not going to grow as fast as it was perceived to, is still growing. Therefore, I think that there's a bit of a misconception right now that silver should be in the penalty box because of its exposure to the ups and downs of the economy.
Yeah.
So I like the breakout there. I think it's going to play catch up, and maybe if we have a really severe recession, it's going to just kind of sit around here. But I don't think we're going to have a severe global recession. By the way, I think we're going through a recession in the U.S., but a lot of these other countries, as you know, are stimulating. It's an odd situation. I mean, I think Donald Trump has created this military spending boom around the world, which is another reason why you might want to be bullish on silver. And I also thought it was interesting listening to Neil Howe because which I did actually just last night, re-listen to it, and there's a company that I would suggest, since I can now do this, that your listeners check out. I'm not saying buy, just check it out, called CRH, like Charles Robert Horatio. And it's a aggregates company. And he was really talking about how with all the infrastructure spending that's going to occur in the United States, that he wants to have exposure to that area. And I think this is one of the best ways to play it. It's about 16 times earnings. If you look at its peers, Martin Marietta Materials and Vulcan Materials, they sell for like 25, 30 times. So huge discounts, had a tremendous growth rate. Their earnings have gone up 450% over the last decade. And it was listed in the UK. It's now listed in the United States, and most of its business is in North America. But it's off the radar of most U.S. investors, so I think it's a pretty interesting play. Just a little bonus idea for your viewers.
Well, two follow-up questions I have on that statement. So first of all, the fact that other countries are stimulating, do you think then that there are other opportunities outside of the U.S. that are better for equities investors right now?
Absolutely. And actually, the U.S. is lagging overseas markets by the greatest margin since 1993. This has been part of our great rotation theme, which has only partially played out, which was a rotation away from the Magnificent Seven, the U.S. exceptionalism, where the U.S. market cap got up to 70% of global market cap, and now the money is starting to shift. And I think a big concern for U.S. investors should be the fact that foreigners own about 18 trillion of U.S. equities. And the U.S. is making it clear we really don't want their money. And by trying to drive down trade deficits, what that's also going to do is hurt the capital account surpluses. So the inverse of the trade deficit is the surplus of foreign money coming to the United States to fund those trade deficits. It used to go into treasuries, but as you know, it hasn't been doing that for about a decade. it's been going into the S&P and the Nasdaq, and particularly the mega cap tech stocks. So that's reversing. And if foreigners really get negative on the U.S., which they clearly are becoming much more concerned about our respect for the rule of law, about our respect for the dollar's reserve currency status, about our attitude towards foreign countries. You saw the election up in Canada, which went very surprisingly from a few months ago because of the 51st state stuff. And so I think that we're playing fast and loose with American exceptionalism, and I think we got to be careful. We might be driving a lot of foreign capital out of the country when we need it, because who's going to fund these $2 trillion deficits? Which the whole what happened to Doge? That's kind of fallen off the headlines, and the latest I've seen on the federal deficit is pretty alarming, including federal salaries up 14% year over year. So it's frankly, I think that it is very much in line with Neil Howe's view that we're in a fourth turning, and I don't think bull markets are consistent with fourth turnings. And I think that America is kind of on the firing line for this fourth turning, and that some of these other countries, because for one thing, they've been lagging for so long, and their valuations are so much lower, they're much less exposed. So yes, I think to answer your question, long-winded way to say, I think that it makes sense to be rotating overseas with U.S. investor capital. Not totally, of course, but I think we're just way too exposed to our own stocks.
One thing that I spoke to Neil about is these cycles that happen every 80 years. Like you're correct. He's calling for a fourth turning now. Based on your observation, how long do you think this fourth turning could last? I mean, nobody knows for sure, but I'm just curious to get your take.
Well, this is just an off the cuff, and maybe it's more hopeful than rational, but I believe that by the time we get into the 2030s, we could be into a boom phase. The new first turning, which is the good part. But I just think we have to go through a lot of pain first. And I think part of that pain involves getting our government debt to GDP down meaningfully. And I don't think that's going to happen through big tax increases, which can be kind of self-defeating. I mean, you've probably seen the stats. I mean, it doesn't matter what the tax rate is. The maximum tax revenues the government collects about 20% of GDP. We're not too far below that. We've clearly got a spending problem. How, with this current Congress and administration, how we're going to deal with that is not clear. Like I said, I mean, the whole Doge movement seems to be just dead in the water right now. So how do we more plausibly, or it's not great, but I think it's more likely get out from under it? I think it's with a lot of inflation. So that's what we did after World War II. We had a lot of inflation in the post-war period, and we got our debt to GDP down from about 120% to about 70% in just about 7 years. So I think if you recognize that, which again I think is very consistent with the fourth turning as kind of your overarching thesis, then you invest for higher inflation, and that naturally leads you into hard assets, some of which are doing well, but a lot of which have really lagged. A lot have been pounded because of recession fears, which I think creates an opportunity. But I realize that the recession risks are, if anything, going to be going up for a while, not down.
Okay. Now, the other point I wanted to make is stimulus. You mentioned stimulus in other countries. What about stimulus in the U.S.? How do you think the Fed would respond next week to today's GDP data? Do you think stimulus is on the way?
Don't know. I think the Fed is very reluctant because you were talking about some of those inflation numbers too. I mean, this is kind of a stagflation environment that we've got on our hands right now, and the tariffs aren't helping that. And those are going to drive prices up and probably hurt profit margins at the same time. So it puts the Fed in a very difficult position, and of course they're not fans of Mr. Trump, right? So their desire to bail him out, I think, is pretty low. But I think they've really got a legitimate case that this would be premature to go into a massive easing cycle right now with all these kind of lingering inflation pressures and the looming ones from, I mean, like we talked about the supply chain problem. Look what that did to inflation back in 2020, even though the economy was quite shut down. I know that inflation really took off in 21, but the Fed's mindful of that. And the last thing they want to do is see another inflation surge on their watch. So I think they're going to be very reluctant. It's going to take some pretty nasty, not just soft data, because that's what the economic bulls say, David, is, well, it's really the recession's in the soft data. It's not in the hard data. But it looks to me like some of this hard data is starting to reflect the soft data.
And finally, what are you most bullish on this year, given our conversation?
Well, earlier I think you and I talked about, I was very bullish on the yen. I thought the yen was a great fragile non-fragile asset, and it's up 10% this year with a lot of things down. I still think it's going higher. It's correcting a little bit, and maybe waited for it to back off a bit more. But I think that it's going to go from say 143 to the dollar to 120, maybe even eventually close to 100 to the dollar, which would be a big appreciation. I'm particularly bullish on uranium. Uranium's been hit very hard, and it's non-cyclical. I mean, really, the demand for uranium has nothing to do with the global economy or the U.S. economy. There's just enormous numbers of new facilities, new nuclear facilities. 3 more just announced in Poland. China just announced another 10. So that you've got demand increasing rapidly for uranium, and the supply is very constrained. But right now you've got a lot of shorts on the spot market, which is not where most of uranium trades. Very little uranium trades on the spot. Almost all the trades in the contract market, which is somewhere around 80. The spot market's at about 65, and you can buy the spot uranium ETF SRUUF at about a 9% discount from a discounted price. So to me, that's one of the biggest layups out there right now is uranium. But I do like palladium as well and platinum. I like a lot of these hard assets where most people are grossly underexposed.
Okay, excellent. Thank you, David. Let's talk about your announcement, a new development that you have now. Tell us about your new work.
Well, so what we can do, and I think probably better to just show it, is that now we can be pretty specific with our recommendations of, so we've got 4 portfolios, 2 model portfolios where we're actually saying buy these because they're asset classes slash ETFs. And so we have an ETF growth model, we have an ETF income model, but we also have an individual securities tracked portfolio. So with individual securities, we might say we like this, check it out, like I just did with CRH, but we don't actually say buy. I think that's really got to be an individualized decision. But we will be, quite specific with a number of these ideas that we like. But the idea that now that I'm no longer at Evergreen with all the compliance restrictions, I can be much more open in terms of what we like and don't like. I will say that one of the things that we hope to provide, where I think there's really a deficit of guidance, is with income portfolios and income investments. There's very few of our competitors get into that area. There's a handful that do. And I think a lot of people that are your listeners are, more my generation. There we go. So that's the model ETF income portfolio. And then we also have the model ETF growth portfolio. Don't have to spend a lot of time on that, but if you subscribe to our newsletter, you can access this. It's a very reasonably priced newsletter. And I think just, one good idea per year more than pays for the newsletter, and we'll provide a lot more than one good idea per year. On this list that he's got right there, it's if you look at toward the top, it's the right above the second green line where it says simplify MBS ETF MTBA. That's really an interesting one for income investors because it yields about 6%. Run by Harley Bassman, who's one of the best in the mortgage-backed universe. It's an ETF that you can easily buy, and I think it's a great safe harbor. It's been very non-volatile with all this volatility we've had lately, so kind of a good stress test. And I think people need income ideas. I'm going to be writing up an income idea that we'll publish in our Making Hay Monday. So we give pretty specific trade ideas on Mondays, or if it's a holiday, Tuesday, right after that. And then our macro pieces are on Friday, often guest authors. And then we do a daily, which has become, we just started doing this a few months ago. It's become very popular because it's such a quick read and interesting things that, like we did the Zweig super breadth thrust here recently. So yeah, there's a lot of information for people to access. I mean, I've been doing this a long time and haven't. I think probably the biggest advantage I have, David, is I know so many brilliant people like Grant Williams, and I don't personally know Neil Howe, but I certainly know a lot of people who know him.
Mhm.
Jeff Gunlock's not an acquaintance, but somebody I follow very closely. Kevin Muir, who is a friend, Jesse Felder, who is terrific. So I have this, really, I've been blessed with this remarkable network of brilliant people, and I share their ideas with my subscribers, and I think that alone is worth a lot.
Yeah, absolutely. Well, we're looking forward to this. So, congratulations on this new income portfolio. Where can we get in touch with you, David?
So we have that at the bottom of that. It's the Haymaker .substack.com. I think if you just even come close, I don't know how critical those dots are, but you can see it at the bottom there.
Yeah.
So yes, please.
Haymaker.substack.com.
Yes, there you go.
All right. We'll put the link down below. So make sure to follow David Hay at haymaker.substack.com. And well, congratulations again, David. Welcome back to the show. And thank you for your insights today.
I don't know how insightful they were, but it's always a pleasure to be with you, David. And again, congratulations. 270,000. That's just amazing.
Getting there. Just constant grind up. Never stops. But appreciate you coming
Well,
on
you
and
put out a
helping us.
lot of content. I listen to you almost every day. I really do.
Oh, well, I
You
appreciate
you
that.
got so much new stuff up there.
That means a lot
So
coming from
again,
you. All right. So make sure to follow David there. And yeah, well, speak again soon, David. Take care for now.
thank you, David.
And thank you for watching. Don't forget to like and subscribe.